Whether you're a founder just starting out, a seasoned business owner looking to expand, or simply interested in learning about the world of business, this podcast is for you. My name is Mario Schäfer, CEO at OneID. In each episode, we will explore topics related to the creation, growth, and globalization of businesses, from ideation and funding to marketing and operations. Our guests will share their insights, experiences, and lessons learned along the way. Join us as we dive into the world of entrepreneurship and business on this podcast. Please follow us on YouTube. It's a pleasure to be here today with Florin. Could you tell us a little bit more about yourself?
Sure. I'm an operational startup builder at heart. That's how I would describe myself. You can also say that I'm an in-house generalist, sort of a Swiss Army knife for startups. I see that as my responsibility to do what needs to get done to keep the company growing. Kind of like the person that just give me an idea and my brain will start building the process and try to productize it. I'm also like a two-time founder, but I think in the last 5 years, I've been involved in the Berlin startup community since 2018 as a founding member of Florin-Catalin, where I had the opportunity to launch two exciting projects. One of them being the Berlin Founders Fund, which is an early stage startup accelerator where I worked with more than 20 VC startups, which have gone to raise, I think, over around 50 million. So that's pretty impressive for the first time accelerator program that our team has been running. And another project close to my heart is Residency, which is a soft landing program working with government and agencies to actively support foreign international companies from all over Europe, Asia, and LATAM to expand to Germany and beyond. So yeah, that's pretty much about me and what I've been working on for the last 5 years.
All right, Florin, given the challenging economic environment and recent bank failures, how do you see the European venture capital landscape navigating these obstacles and adapting to potential market uncertainties in the remainder of 2023?
So I think the European venture capital landscape is undoubtedly facing some tough terrain, but that's pretty much everywhere right now. However, its challenges often breed innovation and resilience. And I feel like looking ahead to the rest of 2023, I do see a few key ways in which I think the European venture capital team might navigate these obstacles and try to adapt to this potential market uncertainties, right? I think one of them being diversification of investment strategies. I see venture capital firms likely explore more diversified investment strategies, spreading risk across different sectors and regions. This approach can help mitigate the impact of any single sector or market downturn. So, pretty much don't put all your eggs in one basket kind of thing, right? Being marked in a lot of deals that maybe made headlines being busters is, increased due diligence, right? I think there was a craze of just investors running with their cash, not even looking at term sheets, just writing blank checks as caution comes paramount. I think venture capitalists might conduct even more rigorous scrutiny for investing. And they should, right? I think it's very important for capital allocators to be a little bit more diligent before investing and hold funds accountable a little bit more. So thought assessments of the company's financial management team, I think, and market data will be pretty crucial. And I think also focus on strategic fundamentals is pretty important. Investors may prioritize startups with robust business models, solid revenue streams. And obviously right now everybody's talking about profitability. I think all the investors have been more diligently focusing on their portfolio to, get those companies profitable, because companies can weather economic storms are more likely to secure funding in uncertain times. Ultimately, the European venture capital landscape will likely require a combination of adaptability, I think, prudent decision-making, and focus on fundamentals to steer through the challenges posed by the economic uncertainties that we're feeling right now. It's an environment that calls for a measured and a strategic approach. We should always be a little bit more diligent, but I think that also one that holds the potential for growth and transformation. This is my personal take on your question, Tobias.
With IPOs and mergers expected to decline while liquidations continue to rise, How can these early stage startups and scale-ups strategically position themselves to attract venture capital investment and sustain growth in these current market conditions?
There's not one size fits all. They're like businesses and their industries, and building companies within a certain industry requires like different strategy. But I think the fundamentals again are at play here. First of all, just focus on building a strong product or service, right? Because this is still the most important factor in attracting investors and kind of connecting to what I just said previously. You've seen this crazy deal rounds, especially 2021, which was an higher year in terms of investment, like investors just running with blank checks, and there was not even a product, like a working product, right? There was like the wave, a trend in certain industries, and investors were just rushing to this. That's the investor's fault. But I think from the founder side, just focusing on building a strong product, it's very important. Make sure your product is solving a real problem in a meaningful way. Another thing is to demonstrate traction. Investors want to see that you have a viable business, that your product is resonating with your customer. Show that your growth metrics and other data that proves your business is on the right track. Another kind of element here, especially like early stage, right? Because we talked about, like I mentioned, the product, but before a product, there's the team, right? And that's what you invest in at the beginning. So build a strong team, because that's the product. At the beginning, you might have projections, you might have some sort of product to show, but it's you that I invest in and I believe in, that you're capable of building this idea. So make sure you have a strong management team in place with experience and skills to execute your idea. Another thing, from kind of what I'm seeing and also like what I'm reading, it gets cheaper and cheaper to build, especially software companies. And many businesses out there operating in different environments and industries, a majority is still predominant software, and software companies are becoming easier and cheaper to launch. So I would say bootstrapping and be independent, because it requires less funding, right? You don't need to rush and just raise some money, because that's pretty much what everybody does. They lean like bootstrap and kind of lean into whatever revenue you can make for as long as possible. You can leverage that down the road, right? The tech market is cyclical and there will be ups and downs, but if you focus on building a great product, demonstrating traction, and above all, building a strong team, I think you'll be well positioned to succeed even in challenging times. That would be my answer to your question, Mario.
So if we take a closer look at the first half of this year, we have seen a mix of market volatility and shifting economic factors. For instance, raising interest rates, just to name one. How do you advise startups to evaluate their founding strategies and investor relationships amidst this changing landscape, especially in terms of long-term planning?
Well, one of them is sort of connected with my previous answer of just try and stay lean and don't rush to just raise funds, because obviously now it's a little bit easier to build a company. So you can use that into your advantage. But if you do really need to raise some money, I think startups should explore like a mix of equity, debt, and alternative financing options. Like startups that rely on multiple sources of funding are better equipped to withstand market shocks, because obviously this approach reduces dependence on a single investor type and ultimately enhances resilience, right? If you already have some investors, then maintaining an investor or building an investor relationship or strengthening that is also very important, right? Like always maintain transparent, open communication with existing investors is very crucial. Startups should provide regular updates on performance milestones happening out there. And ultimately, I think also startups should be realistic about their valuation. Again, I think here I'm focusing on the ones that maybe already have raised their first round or second round, but startup valuations have come down, obviously significantly in the last year, and we've been witnessing that. So be prepared to accept a lower valuation than you might have expected in a more favorable market. You should be flexible with your funding terms. I think that's part of it. Investors are looking for startups that are willing to negotiate on funding terms. Be prepared to discuss things like equity, dilution, liquidation preferences, and board seats. Those are all very important things for you to consider. Yeah, on considering side, startups should look more on long-term outlook for the company when making a decision about valuation. If they believe that a company has a strong future, they might be willing to accept the valuation in the short term in order to secure the funding they need to succeed. A case where some of the deals or single deals that I've been personally participated in had taken that proactive approach, which ultimately, obviously, it's understandable, but just kind of like shows again like that founders are resilient and they're willing to adapt, right? And automatically that's a sign of a strong team. And ultimately, me as an investor, I'm more, let's say, safe or de-risk my already risky bets, but I have then more confidence that they are able to take tough decisions. Exactly. That's well put. I think founders should look at founders that are able to take tough decisions. That's always going to be the case, especially early stage. And those might be winning tickets. That would be my answer to your question, Tobias.
In the context of the anticipated decline in venture capital deal value in the US, what trends are you observing in the European venture capital investments? Do you think there are specific sectors or regions within Europe that seem to be more resilient or attractive to investors?
I think European venture capital investment is still growing, albeit at a lower pace than in previous years. But then again, I think we're used to compare a lot with 2021, maybe 2022, where it was just like a mid rush there, right? But it's growing, right? That's, I think, what we should look at instead, not at the velocity or rate, but the fact that it's still healthy. But that's to be expected. But it's also a sign that investors are still confident in the long-term prospects, I think, of investing in the tech market, the European tech market. Personally, I'm a big fan of the European tech ecosystem. I'm excited to see how it's evolving. I've been keeping an eye on the European venture capital market, and I'm seeing some interesting trends. I'm really excited about the trend I'm seeing, especially in the generative AI, which seems to be top of mind for many. And it's having a record year in terms of funding. This is really exciting technology with the potential to revolutionize a wide range of industries, right? Like we're talking about healthcare to entertainment and everything in between. But first, there's been a decline in deal values, which is in line with what we're seeing in the US, and that's to be expected. Investors are becoming more cautious, as I also said in the other replies, but they're looking for startups that are generating revenues and have a clear path to be profitable. Second, another thing I'm seeing is a rise in later stage investments. Investors are more willing to put money into startups that have already proven themselves rather than taking a risk in early stage companies. It's good and bad. Obviously, that keeps the wheel spinning, right? But then I think there's also like more, let's say, options or other funding alternatives for early stage startups. And here I can put on top of my head something we've been working with for the last 40 years. It's public funding from the European Union. I think there's so many amazing programs out there. I know that comes with a lot of admin burden for companies, but it's out there, right? It's not free money, but it's almost free, which I'm really happy to see that European Union is doing like a great job of supporting early stage companies through various subsidies and grants. There's a focus on specific sectors, obviously, besides the AI base, which is another exciting trend that I'm excited about, is the growth of purpose-driven tech. This is a sector that focuses on using technology to solve social and environmental problems. I think this is a trend that's here to stay, and I'm glad to see that investors are starting to take notice. I'm bullish on the future of European tech, and I think it has the potential to be a major player in the global tech landscape. I'm also confident that the European tech ecosystem will continue to grow and mature in the years to come. I think the structural green shoots that we're seeing now are a sign of things to come. And I'm excited to be part of this journey. And I can't wait to see what the future holds for European tech.
Florin, you've already mentioned the decline in the US venture capital segment, at least for early stage companies. But besides, we also see a decrease in mega round activity in the US during this year, during 2023. How do you see this trend influencing the European startup ecosystem? Are there any opportunities for European startups to stand out and capture the attention of international investors? And how can they leverage these opportunities effectively?
I've been following the state closely, and I'm interested to see how the decrease in mega round activity in the US will influence European startups and what's next for the European ecosystem. So on the one hand, it could mean that there will be less competition for European startups. With fewer mega rounds happening, investors might be willing to invest in smaller early stage companies, which I think I've been noticing that as well with the VC, for example, maybe focusing on Series A and above would also participate in some pre-seed, right? But this could be a good opportunity for European startups to get their foot in the door and get the funding they need to grow. On the other hand, it could also mean that the investors will be more risk averse. With the global economy in a state of flux, investors might be less willing to invest in risky bets. So it's like a double-edged sword here. This could make it difficult for European startups to raise the capital they need to succeed. But as I mentioned before, I think in times of crisis, we're always like resilience is being forged. And yeah, I think overall, it's too early to say how the decrease in mega round activity will impact the European startup ecosystem. But what I can say is that I'm confident that the European startup ecosystem is strong enough to weather the storm of a decline in mega round activity in the US. So I'm excited to see how European startups seize this opportunity and build an next generation of global tech giants, because I think we might not be at the same table with countries like or ecosystem like US, but we surely have the potential to get there. That will be my answer to your question, Tobias.
Thank you, Florin. To close, how would you describe venture capital in 3 words?
Elevator pitch. Venture capital investments are like a box of chocolates, right? You never know what you're going to get, but you're willing to take a risk. You could end up with a big payoffs. And if you're looking to invest in companies that are making a difference in the world, then venture capital is a good option. So to answer your question, here are my 3 words to describe venture capital investment. One would be it's risky, right? But that's why we're in the game. Because it's rewarding. It would be another way of describing it. And one which I would like to be described a little bit more, it's purpose driven. So let's make sure that the last word is the one that we focus on the most. Like less of short-term gains and look more towards long-term gains instead.
Thank you for being with us today, Florin.
My pleasure. It's been amazing. As I said, those are my personal thoughts, and I'm happy to share them with you guys.
Thank you, Florin.